You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
You wanted it, you got it. A radio program that helps teach you options trading inside and out. Basic to complex. This is Options Bootcamp, brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, everybody, welcome back to Options Bootcamp. This is, of course, the program where we take you, the raw options recruit, and we break you down mercilessly, very painfully, in fact, and then rebuild you into seasoned options veterans. My name is Mark Longo from theoptionsinsider.com, as well as from this here Options Insider Radio Network. And before we get started with the show proper, let me just mention right here at the top of it that a lot of you have been asking for a long time, when is there going to be an Options Insider Radio mobile app? Well, that day has finally come, listeners. We launched the app last week, actually, and we launched it across a variety of platforms. So no matter what you really use, what your platform of choice is, we have a version for you. We have a version for iOS, so all you iPad, iPhone, iPod users, we have a version for you. We, of course, have an Android version for all you guys out there using the myriad of different handsets out there. We have an Android version for you. And even you Amazon Kindle Fire fans, we have a version for you guys out there. You, of course, can find the app in your respective app stores. Just go to the Amazon App Store, the Google Play App Store, or, of course, the iOS App Store, and search for Options Insider Radio Network. You'll find it right there. We're the only ones, I guarantee you. And you can check it out. It's a great app. It allows you to stream, of course, all of our shows. So you can make a little cool playlist of my shows, the shows you like. So, for example, if you're tired of hearing Dan Passarelli on this show, you could not add this show to your list and vice versa. And a lot of fun things you could do with it. You can, of course, also download the programs for offline listening. If you're on the subway or commuting on a train, you can queue up a bunch of shows that way. And, of course, you can get in touch with us here on the show. There's a lot of great ways, too. You can tweet at us, Facebook, post it on your wall, or, of course, shoot us an email right through the app itself with questions. So it makes it even easier for you guys to get in touch with us here on the program. So go check it out. iOS App Store, Google Play App Store, Amazon App Store. Just search for the Options Insider Radio Network. I think you're going to like what you find. And joining us on the program, I am joined by my usual companions for the Options Bootcamp Drill Instructor Squad, plus one new addition to the team for this program. It should be fun. But let's start off with the regular, starting off with the man I know you guys are all sick of course, none other than the major domo over there at Market Taker Mentoring, my black-hatted drill instructor squad companion, Mr. Dan Passarelli from MTM. Mr. Passarelli, welcome back to the program, sir.
Well, gosh darn it, Mark, it's always good to be here.
I can see all of our listeners right now like, you know what? I'm not going to add that boot camp show. That Passarelli guy, he just rubs me the wrong way.
They wish.
All right, and also joining us a little bit better for the wear from last time, listeners. It's taken him a little while to dig out of this this polar vortex-induced cold he's had going, but he's getting a little better now. He is none other than the options specialist over there at SogoTrade.com, Mr. John Critchley. John, welcome back to the program, sir.
Hi, everybody. Glad to be back. We got more snow coming in New York City. It's just a wonderful, joyous time to be here, and so much for global warming. But we got a great show today, an excellent guest, and I'm looking forward to it.
And last, but certainly not least, I promised you a newcomer on the old program today, and that is indeed true. You may know him from his many appearances on our Option Block program, but he is joining us today here for the first time as a special guest drill instructor, none other than Mr. Uncle Mike Tusaw from RCM. Uncle Mike, welcome to this program for the first time, sir.
Sir, yes, sir.
Yes.
Am I in the right format? Am I getting the feel of this? Am I doing it right, sir?
I think you got it. You got the hat going. You got the whistle. I think you're ready to go.
Thank you, sir. May I have another?
All right, I like it. With the team well and truly formed and pumped for some drill instructoring, we'll go right on into our basic training segment.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Pull in, prepare to learn. Yes, sir.
All right, welcome to our basic trading segment. This is, of course, where we introduce you to some basic options concepts and I'll teach you how to really incorporate them into your own portfolios. And I see I've already deeply offended Uncle Mike, who's not accustomed to the way I make up words on this show here, like drill instructoring. But yes, that is a new word added to your vocabulary, Uncle Mike.
Yes, sir.
All right, and today we're going to mix it up a little bit. Usually we do the mail call at the end of the show, but we're actually going to do it right here at the beginning of the basic training segment because I think you'll see why. In a second, we have a question coming in from Dr. Toboggan, I like that handle, via the Options Insider website, and he writes, love the podcasts, would like to see an episode, and he puts in parentheses, maybe Options Bootcamp, good choice, sir, that covers trade adjustments. This has been the most difficult aspect of learning to trade options for me and would be useful now that you've covered most of the basics on this program. Specifically, would like to hear a discussion on how to adjust trades when the stock moves against you, i.e. the price hits a short strike in a condor or credit spread or the wings of a butterfly. Thanks. Well, it's a great question, Dr. Toboggan, and I featured it here at the top of the show because that's exactly what we're going to talk about here on the program. And we love this when you guys send us in topics. You guys are always sending in great ideas for shows, and we love it. Keep it up. You know how to do it. Now you have the app to add even more ways for you guys to get in touch with the show. But this is a great topic. It's a very detailed topic, too. So it's one that I've often said when it comes to options trading, this is really where the rubber meets the road. You know, there's all the other things we talk about on this show, the different strategies, the Greeks, all the educational materials we've hit on this show over the past year or so. And you can learn all that stuff and master all of it. And if you don't really understand adjustments properly, you can really do yourself a world of harm because this is really where the rubber meets the road. You can take a good trade and turn it into a very bad one with some improper adjustments. And you could also sometimes salvage not so great of a trade with some decent adjustments as well. So it's a very important skill. But I put skill kind of in air quotes there because there is as much art as science as there is often to the art of adjusting. So what are we talking about? What exactly is an adjustment? This is exactly what it sounds like. This is when you put on a trade and it starts developing, things start happening, the market starts moving, maybe volatility starts changing, whatever is going on, and something is unfolding in that position, and now you need to make a change to that position. And that's what we're going to walk you guys through today. Dan, I know you guys probably spent a lot of time over there at Market Taker, probably walking through adjustments. I would go out on a limb and say that's probably one of the lion's share of what you do over there with a lot of your clients. So why don't you walk us through your kind of basic take on adjustments in general and just in general kind of give your thoughts on this whole process here for our listeners.
Yeah, in one of my classes, Mark, I have a PowerPoint slide and I have two rules for trading, like the two most important rules. Rule number one, have a plan and stick with it. Rule number two, change the plan if you have to. Because, sometimes market conditions change, and what you forecasted something to, when you had a forecast initially, sometimes brand new news comes out and it changes the picture, and then it's just being stubborn, sticking to that forecast. Anytime the market conditions change, you kind of have to reevaluate, and you might have to come up with a new plan. And that's where adjusting comes into case. It's a terrible idea for somebody to just not have a plan and just figure, I'll just adjust on the fly and kind of wing it as we go along. That's a terrible idea. You always have to have a plan, know two exit points before even making the trade, where you're going to close it for a profit, where you're going to close it for a loss. However, like I said, when market conditions change, you have to reevaluate and you have to be nimble, and that's where being able to adjust and having those skills to adjust really separates the men from the boys, the women from the girls, and the good traders from the people who end up not making it in the long run.
Now, Uncle Mike, one of the reasons you're joining us on the program today is because you and I were just talking about adjustments recently, and I said, Uncle Mike, this would be a great discussion to have on a program. We just happened to be doing an episode about adjustments coming up, and so it seemed to work out pretty well. I know, Uncle Mike, for listeners who may not be familiar with you out there, you, of course, spend a lot of your time over there at RCM Wealth Advisors, managing accounts for a variety of clients and doing a lot of active option strategies for them, buying puts to hedge, writing calls for income, and doing a lot of other things, diagonals and rolling and all that kind of stuff. So you spend a lot of your time doing a lot of adjustments. So why don't you walk our listeners through kind of your overview, your take on adjustments as well?
Yeah, definitely. I think the first thing that needs to be clarified with an adjustment is that I have a theory that back in the 70s and 80s, when options were first becoming known to the retail public, that the term adjustment came about from brokers trying to tell their clients in a more gentle way that it was a losing trade, meaning, we just need to make an adjustment from this spread to the next spread. But so long as this happens, we'll be okay. And with that being said, I think it needs to be understood that when we try to make an adjustment, it's something that you still have a chance at making a good trade, and you're not just taking a losing trade and creating another losing trade. So my take on adjustments is if it makes sense. And if there is a deal out there, and by deal, I mean, let's say another strike price can give you more time decay or less time decay, depending if you're long or short, whatever the case may be, then it makes sense. But if you're doing something like I saw a client a few years back, and what he did was, and this was not my trade, he just kept rolling his deep in the money put 1 month further out to avoiding the inevitable of taking a loss. And he's losing money by a little bit because the deep in the money put that he was short was so against him so much that it was actually just hurting him, and the only one benefiting was the market maker on the other side of that trade every month and his broker. And so with that, just understand that, is the adjustment an actual adjustment, or is it something to where you're delaying the inevitable of telling yourself that you actually had a losing trade?
The one thing I wanted to mention about the adjustment strategies is, very quickly, it's similar to what we've talked about in the past about exit strategies. You need to have a plan in place. You don't want to exit your trade, but you want to adjust. And the one thing I'll say real quickly also is that when you adjust, don't look back. Move forward, no regrets. I know this is a lot of cliches here, but when you do a trade and make an adjustment, just the problem that people have, or I even have, is that I'm afraid to adjust or cut a loss because, oh my God, what would happen if it reverses and goes back the other way? I'm saying do the trade, have a plan, do the adjustment, and don't look back.
A good plan, sir. Sometimes easier said than done. I don't think we all have that same problem. It's a human failing when we trade. We always wonder what might have been if we had let that call run for another day or vice versa. But c'est la vie, that's why we say there's a lot of science to this too, because you make a nice rigorous methodology to it and you can't really go back and question it because you're obeying the rules that you set up. So Mike and Dan and John kind of outlined a few different scenarios when you're talking about adjustments, but there really are three basic adjustment scenarios. There's the time, so when you actually may want to adjust your trade. Obviously, the first time is when a position goes against you. That's what a lot of people typically think of when they're thinking of adjustments. So like, well, like Uncle Mike said, I sold this deep and out of the money put. Now it's an at the money or in the money put. What do I do now? Or vice versa. You sold a call and the underlying rallies to it. A very frequent question, particularly with covered calls. We'll get to those later. So any kind of scenario where the underlying or with your position moves against you and you need to take a second look and adjust. The flip side of that coin, problem a lot of people like to have, is when the position goes in your favor and now you're sitting on some paper profits. And what do I do in that scenario? That is also a time when you may want to consider making an adjustment. And lastly, I call this kind of the misc category because it kind of lumps everything else together. And it's when something else changes, some other factor impacting your position that you maybe had some sort of assessment at the beginning that has changed, vol explodes, the underlying has a dramatic change, whatever the case may be. Something happens that really alters the fundamentals of the position. Now you have to think, well, what am I going to do with this position now because it's not exactly what I thought it was going in. Those are usually the three kind of basic scenarios and you want to consider making an adjustment to your trade. Now, what are we talking about when we're talking about adjustments? Well, that gets into a whole just deep, long laundry list of different things you can do. We're going to hit on some basics now, and then if we have time, we'll get into some of the more advanced adjustment type strategies. But we'll start off with probably the most basic of all adjustments, what I like to call the final adjustment. That is, of course, just closing out the position. You have a position, it's going against you in this case, in some scenarios, and you say, you know what, I'm really just going to eat this loss because it doesn't look like it's going to get any better, and I'm going to close this out. This also works the other way when the position is going in your favor, and you decide, you know what, I've got some profits here. You never go broke really taking a profit. The second part is the flip side of that coin, the better one, when you have a profit and you think, you know what, you never go broke taking a profit. I'm going to take this off the table and move on to the next trade. That is, of course, closing out the trade itself. And I call it the final adjustment because it is. There really is not much else you can do once you've closed out a position. That's kind of it. And that gets into what John was just saying. That gets into what we've talked about on the show in the past, getting back to some very basic trading methodology of having a plan and implementing that at the start when you put on that trade, that position. We said before, we're talking about closing out short options on this show very recently. When you're shorting that option, work that buy order to buy it back as soon as you put the position on. So if you realize you're going to buy it back for a nickel, whatever the price may be, so it's all set and ready to go, so you don't have that problem of hemming and hawing and deciding, should I pull the trigger? And these types of trades and these types of adjustments, hopefully you have that in your mind ahead of time. If the underlying moves to X point, or if this option increases in price to this level or it decreases in price to this level, I'm going to either cut my losses and go, or I'm going to take my profits and go. And that's kind of the basic adjustment strategy. There really isn't. It depends on the person. It depends on your risk management style, your risk aversion. All these different things go into what is a proper level to close it out for you, how much profit you want to take, how much risk you're willing to take for that profit. It really takes some doing to come up with that. So that's not something we can really run through here and say, here's exactly when you should close out a position. I think you know that better than we do on this show. But getting into some of the other ways you can adjust positions, I know, John, this is one of your particular favorites. This is, I think a lot of us do this as well. This is when you start closing out portions of a trade. And you may do this for a couple of reasons. Maybe you have something that's going against you a little bit, and then you decide, you know what, I'm going to take a little bit of this off the table, take the loss on some of it, and maybe I'll do something else with the rest of it here. And so you decide to take a portion of it off. But it's usually more commonly done when you have a winner. And let's say you buy a call on XYZ, the underlying rallies, and now these calls have tripled in value. You can take off, you say you did 10, you can now take off 2 or 3 of those and sell that, and you essentially have paid for the entire outlay of the trade. And so your trade is now free from that moment on. And that's a kind of position a lot of people like to get to because it just takes a lot of the worry out of that trade. And even if the worst happens, you don't implement proper risk management strategies and the trade goes against you and you lose all the rest of that money, you haven't lost anything. You've broken even on that trade. Now, John, I mentioned you earlier because I know this is one of your favorites. Walk us through your thought process when you're thinking about when you want to take a portion of a trade off.
Well, this is definitely my favorite type of trade. And as the listeners may know, I play from the long side. So if I can put a trade on, let's say I buy 10 contracts, And if I can sell 3 or 4 or 5 and get my initial outlay all back, now I think to myself, wow, I own these options for free. But the one thing I want to stress, that's my philosophy or the way that I trade or like to trade. But there is a downside to this. If you buy 10 contracts and if you're able to sell 5 to make the initial outlay, well, what happens if you sold all 10? You know what I'm saying? You're in the making profit. So it's a trade where you're kind of just you're not really rolling the dice, but as Mark said, if you sell these options and then they collapse again, then you made no money. Or we sold them all, you would have made some profit. My point here is that do what's comfortable, and this is my favorite trade. I like to shoot for the home run, so to speak. But if you're a retail trader and you like to play singles and doubles, then this strategy might not work for you. Again, work with what you're comfortable with. I just like to go for the home run, and if I can take something off and own it for free, and I'll just take a shot that maybe I'll hit a home run, and if it goes back to 0, well, I haven't lost any money. It's just the way I like to trade.
Yeah, we were talking either yesterday or the day before via email, and either Mark or John said that this is their favorite trade adjustment. And I said, well, yeah, it's mine too. And I teach this specifically to my students all the time, especially the guys who play directionally, just buying calls or buying puts. I mean, we've talked in the past before about the statistical nature of trading. Well, when you take off part of a trade and you take all the money off the table, well, now you're in a statistical game where it's not possible to lose money anymore. It's only possible to win money from that point forward, and you can potentially make a whole bunch if the market really continues going in that direction. So I love that adjustment. Love it, love it, love it.
Is that the patented Passarelli adjustment? The PPA, as it's known on the street?
Go through emails and see who thought of it first.
That's just one way, of course, is taking off that partial one. And you're right, John. That's a great strategy for the types of trader who may be a little bit more risk averse. They like to sleep at night, and they love the fact that, hey, you know what? I've covered my costs. The rest of this is just gravy. That's a very, I think, reassuring mindset for a lot of people, particularly newcomers to the realm of options who are used to trading stocks and kind of just getting their feet wet in options, and they're probably starting off buying some premium. They can cover that cost, and the rest is just gravy. That's a pretty easy way for them to sleep at night. But now the next way you can adjust, and a very common one as well, is usually when a position goes in your favor, but it also can work going against you as well, is when you start adjusting into a spread. This is what I like to call kind of like a rolling type adjustment, for lack of a better word. A good scenario, you buy, let's say, a little bit out of the money call in XYZ, and then XYZ starts rallying. Well, now this call is suddenly at the money or even in the money, and it's quadrupled in value, let's say. Now, what do? This kind of gets back to what we were talking about before. One of the options in that particular, of course, you can close it out, take your profits. The second part of it is, like we said before, maybe if you're that kind of risk-averse person who wants to kind of play with the house money a little bit, you sell a couple of them out and you're flat on that trade and the rest of it is just gravy. Of course, doesn't mean you can set it and forget it. You want to keep an eye on that because you could give up all the rest of those profits. But that said, if that's your style, you can always go for that as well. What a lot of other option traders will like to do sometimes is they'll leg into a spread. And remember, we talked about spreads many times on the show in the past. You can go check out our archived episodes, listeners, for us walking through basic and advanced spreads and spreads with wings and all that fun stuff. But a simple vertical is a great thing to leg into if you have something that's really running your way. This call has quadrupled in value. The at-the-money strike is now severely past where that call was. That call is now a deeply in-the-money option. That gives you some options, pun intended. You can, of course, like I said, sell out that one, sell out a portion, but a lot of people like to also perhaps sell a higher strike option. What they've done now is legged into a vertical call spread, and depending on the strike you choose and the strike differential and the level of premium on that strike, you can sometimes get a free vertical spread out of it. Sometimes you can even get a credit, so you're essentially buying a spread and getting paid to do it. That's always a nice thing. And sometimes you can get a spread for a dramatically reduced amount because you're taking this inertia of the market and putting it to work for you. And why would you want to do that versus just selling out the spread or selling out a portion of it itself. Well, it's the kind of thing where you think the underlying is going to keep running, but you want to still have some skin in that game. You don't want to take off the call just yet. So it allows you to have a nice position. It's kind of another way of looking at playing with the house money a little bit, in that you still have this position on, so you could lose that value that you have left in that spread, but if you put it on the right way, you're going to take away most of that premium risk, and you have a very small outlay, if not a credit, on this spread. Now, Uncle Mike, one of the reasons I wanted to have you on the show today is because I know you love all sorts of rolling spread type adjustments, in particular the stupid. We can get to that a lot later, because that's not really an adjustment. It's more of just a silly thing you like to do. But walk us through some of your methodology when you're doing this, when you would actually leg into a spread versus just closing out the position versus just closing out a portion of it. What's your thought process on all that?
To the call side, let's say that I'm just long a call option, and the stock goes my way. They find the cure for cancer, create world peace, stock goes up, or they're just Apple, one of those three things. If that's the case, then typically I'll just get out of the call option. And not much of a fan of legging into a call spread on the upside. Put side, I like to leg in if I want to have continued downside. So, for example, let's say I buy a put option, whether it's in the money, at the money, or out of the money, and the stock goes my way. This thing is just sinking like a rock. They didn't find the cure for world peace, or they're just Apple on another day, for example. If that's the case and the stock's going my way and I'm bearish and I'm on the right side of the trade, at that stage, I like the idea of legging into a vertical, and here's why. I'm a believer as a trader in the inverse relationship with the stocks and the VIX. So in other words, if stocks go up, VIX goes down, stocks go down, VIX goes up. Now for long-term hedging, do not listen to that one bit. I don't believe in that one bit. But for shorter-term trading, oftentimes as the stock goes down, volatility will go higher. So with volatility going higher, you then will have the ability to have more juice, so to speak, to sell on the downside. So let's say, for example, XYZ stock is at 50, and I buy the 55 put option, an in-the-money put option, because I'm bearish. Stock starts going down, and all of a sudden the stock's at 44, 43, something like that, and I think there still might have a little bit more downside to it, and I don't really want to get out of the trade yet, but I see some really nice premium forming at the 45 level because volatility's gone up. At that stage, I would consider legging into a bear put spread, and it's what that basically does is it creates a debit spread that I would then treat and manage risk like a bear call credit spread along those lines. So that's probably the main time with which I would like to leg into a spread in one way, shape, or form.
So you're saying your primary decision criteria is really the volatility skew, and you're saying that to an extended move to the upside, that implied volatility is going to come off. It makes it less attractive to sell a farther out of the money call, whereas on the downside, you're still getting some of that put premium from the implied volatility juice, as it were, and so it makes it more attractive for you to leg into a vertical on the downside versus the upside.
Yeah, not every time, but oftentimes there does. And sometimes like I'll do this concept like with gold, because sometimes gold has kind of a world of its own with that inverse volatility skew. It doesn't really exist the same way in gold, but yeah, and long and short of it, that is correct.
Now, another way that a lot of people like to adjust their positions, particularly when it comes to options, is the roll. Now, the roll can come in pretty much two forms. You can call one the good roll, I guess one the bad roll, for a lack of better terminology. Your use case may vary. A good roll being the kind of scenario we were just talking about, the kind of one you want to be in, where you have a position that's going in your favor, and now you decide, hey, I like this position. I want to take some of these winnings off the table. But I think there still may be some upside to a position like this, so I'm going to keep rolling on up to, let's say, a higher strike for a call, a lower strike for a put, or some different strike for a spread. Something along those lines. Those are the kind of scenarios you want to be in. Unfortunately, what happens most of the time with rolls is that it's the opposite side of that coin. It's when the position really goes against you that you decide, like this example Uncle Mike was talking about earlier in the show, where you wrote an out-of-the-money put and the underlying really moves aggressively against you, and now you're scratching your head and saying, wow, what do I do with this one? And there's a lot of different criteria that come into this roll versus closing out type of decision. Hopefully you've established this at the outset of that trade. It's not something you're kind of making up on the fly. Unfortunately, a lot of people do the latter, which is kind of why I say adjustments are as much art as science. Even though we like to try to make it as much science as possible, there still is a lot of emotion and a lot of sometimes hand-wringing and stroking of the old beard while people look at their position and say, is there still some juice left in this? Should I close it out? Should I roll it? So, Dan, I know I talked before that you spend a lot of your time with your students there and your clients talking about adjustments. Rolling a loser is probably the number one question you probably get from an adjustment perspective. So walk us through some of your basic criteria for when you would roll a position versus when you would close it out and those types of decisions.
Yeah, the thing about options that makes them different than things like buying a stock is that options are contracts that expire at some point. So you might have on a trade that you really, really like, that you think is a good trade, but all of a sudden it's going to be taken away from you because it's going to expire. So what do? Well, what you can do is you can roll. Keep that good trade going. If it's working out for you and you don't want it to end, then don't let it end. Take an action, do an adjustment, do a roll. One of the things that I spend a lot of time teaching my students is rolling time spreads in specific. Setting up a time spread from the beginning and kind of planning to roll if the trade continues to work for you is both art and science, and it can be really, really beneficial. You kind of have to plan a little bit ahead with that, buy a super long, a long-term option, maybe longer than you otherwise would, so that when the short option is about to expire, you can buy that back and then sell the next month and basically just do a roll by simply selling a time spread to continue that time spread position. So that's one of the applications that, man, I spend a lot of time teaching my students, and it's one that I like to use personally in my trading.
Yeah, and we're going to get to the more elaborate type adjustments, the spread adjustments, in a few seconds. I want to make sure we cover the basic single leg first for all of our listeners who are kind of coming to adjustments for the first time. But you're right, Dan. That's one of the reasons why we cover this on an options show. You don't really hear adjustments on an equities type show because you're kind of limited in the type of adjustments you can do. You buy a stock, you can either sell it, you can sell a portion of it, and that's kind of it. You can't really say, hey, I want to sell the rest at a higher price and keep this here. It doesn't really work that way. But options, you do have those options, pun intended. And so sometimes these options can be overwhelming to the point where people say, what do I do? Which is why we talk about these types of adjustments here on this show. And another reason why I like to say adjustments are as much art as science is sometimes the roll decision is usually something that involves a changing criteria. When you set up a position, you're usually going to say, if you're trading the right way, the way we've talked about on the show many times, you're going to say, if this underlying gets to here, the option gets to this price, I'm going to sell it. If it gets to here, I'm going to cut off my losses. And you have some sort of plan in mind. When you're thinking about a roll is usually when that criteria has somewhat changed. And maybe you have an out-of-the-money call. You wrote it, and in the past you would have thought, hey, I'm content with the underlying being called away or me just buying it back if it gets to this level. But now you're thinking the underlying continues to rally. Maybe the fundamentals of that stock have changed. It looks like it may be on a course to continue rallying. And this is something you didn't have to consider when you first set up the position. That's usually when you start thinking about you want to do a roll. Something has fundamentally changed that makes you say, I want to continue this position in some way, shape, or form that probably wasn't present at the outset of that trade. Now, Mike, I know you do a lot of rolls as well. I joked before you'd like to get into spreads, but you like to roll as well. What is some criteria you use when you're evaluating, let's say, a simple long premium option position when you want to roll it versus closing it out and all the other adjustments we just talked about?
Okay, well, I'll give you an example from a couple years ago. There was the Day of Rage in the Middle East where everyone was going to kill everybody. And I know I need to be more specific on such things, but I think it was 3 or 4 years ago. And we had talked about how the 200 calls on oil actually had a bid. And I think oil was trading at like $85 a barrel. I forget what it was, but it was something to where there was a lot of fear that there was going to be some pretty serious stuff that was going to happen in the Middle East. So what I did is I just bought a bunch of calls on oil, and I think I bought them slightly out of the money. I forget what it was. It was a small trade. It was just a speculative trade. And to give you an idea of it, oil actually went up the next day. I think I bought it right at the close one day, and I was monitoring it just as like a little side spec play for the next day. And oil actually started going up, and then I forget what the exact details of it were, but I'm thinking, you know what? If we're really going to have this day of rage, then it would have happened by now. And I was actually ahead in the trade by, I don't know, maybe a nickel, a dime, something like that. And I decided to get out. And that was an example to where I actually changed my criteria, because initially I was going to do a royal fence swinging on that one. I was going to come out of my shoes. I was going to swing so hard for the fences on that trade. This was going to be have a hunch, bet a bunch, everything about it. But I changed my criteria, and I thought, well, this is actually going against me in that it's not going for me enough yet. And so for being long premium, if it doesn't go my way in a couple days, I typically like to just get out and do something else, because of the fact that the sun will rise the next day and time decay will get you if you let it. So that would be a difference in terms of that would be a scenario to where I would go against my initial profit target, and I just got out for, like I said, 10 or 20 cents on the actual option itself for a profit. So typically in criteria of what I'll look for in terms of doing a roll, I like to look at position delta. So if I'm long a call option, let's say, and I get into it at a 50 delta, let's say I just buy an at the money call, when it goes, usually what I like to look at is once it goes in the money to where I'm actually either at a 70 delta, meaning it's gone my way a little bit, or a lot of time decays happened and it really hasn't gone my way that much, one of the two. Usually when I get up to a 70 delta, that's when I'll either get out or roll or something along those lines. I usually look at the delta as a means as to when I would get out of it. So ultimately, gamma is what's dictating that, but delta is the gauge with which I like to view.
Yeah, that's a good rule of thumb. You know, if you set a level on delta that you're comfortable getting out at or rolling on, that's a good way to guesstimate when you want to make these types of adjustments. Now, you know, we've been talking about the very, very basic level of adjustment, which is typically on this single leg long premium type trade, when you want to close it out, when you want to roll it, when you want to spread it, that sort of thing. But a lot of people tend to equate adjustments with risk positions, and they tend to equate the riskier side of the spectrum with the short premium side of the fence. These are, of course, these option selling strategies that we've outlined on this show many times in the past. Short put, short call, short straddle, short what have you. All these types of positions that involve collecting time decay and hopefully not having the underlying or move quite a bit, not having volatility really blow up in your face and all these other things. You want to stay very steady during those short premium type trades. Of course, as we all know, that very rarely happens. So you need to have plans for when it doesn't really work out in your favor. And so that leads a question we get a lot here on various shows on the network, on the website too, is that do you alter your strategies? Do you alter your adjustments on the short premium side versus the long premium side? Do you maybe keep a tighter rein, a tighter leash on the short premium? Because as we all know, that could really go against you and with some disastrous results. Whereas with long premium, you kind of know going in exactly how much your max loss could be. And so you have a little bit more understanding going in of exactly what the downside of your position could be. Maybe Dan, we'll start with you, because I know a lot of your clients are probably premium sellers. That just is the way it tends to work out. Do you tend to keep them on a shorter leash? Do you tend to make adjustments more aggressively on a short premium position versus a long premium position, or do you tend to view them pretty much the same?
No, I definitely look at short premium trades as having adjustments being a more important part of the strategy. And really the reason for that is the lopsided payout structure. You know, when you buy an option, you have limited risk and unlimited profit. Great. But when you sell an option or put on a spread, then you make a little and you can lose a lot when it goes against you. So, of course, I think we've talked about it on the show before. There's a trade-off between payout structure and probability of success. And it's great that the higher probability trades, you know, you have several winners that are small, and then you can have one loser that is potentially big, but you don't want to have your losers actually come to fruition and be big losers and lose your maximum amount. So it's kind of a way of gaming the system where when you know that you're going to have several small winners, what is that loser going to look like? Well, on paper, at its base level, it looks like it could be potentially very big, but you don't want it to be big, and you have some control over that. You are able to have that occasional loser that you're going to suffer maybe not be that big, and maybe even be able to turn it into a winner. So it really makes or breaks a trader, especially an income trader who's trading these short option, short volatility strategies.
So you will adjust your stops tighter on the short premium side. You'll roll more aggressively on the short premium side. You'll keep a tighter risk profile on the short premium side than you would just with your typical single-legged long premium type trade, because of that, exactly what you said, that lopsided risk reward that you get on the short premium side versus the long side.
Yeah, definitely adjust more aggressively is I guess how I'd say it. Yeah.
Now, Mr. John, I know you're not a huge fan of the premium sellers, particularly when it comes to the puts. So I know you probably have some interesting insight into this one as well. What's your take on your personal, maybe differing adjustment strategy of the long premium type trade versus these types of trades we're talking about now, the short out of the money puts, the short straddles, these types of more, shall we say, aggressive strategies, for lack of a better word?
You know, we have a lot of customers now that are falling in love with selling puts. They've seen what happened in the last year. So what we try to recommend, or I try to recommend, and we've talked about this on the show, and I think Dan has touched on this a lot, is I'm averse to selling puts. So, but if a customer really wants to do that, I recommend, the credit put spread. So if we're talking about when I get a phone call, how do I adjust, or what do I do now that this put spread has gone against me? Well, the first thing is that, when you sell the put spread, so you're selling, let's say, the 115s, buying the 110s. I don't like to do that personally, because I know that I'm buying skew by doing that. I'm buying higher volatility, selling less volatility. But the customer does that and it goes against them. What can they do? Well, sometimes I recommend, or sometimes I just gently recommend, that you can actually you can take the trade on the opposite side. What does that mean? Well, I tell the customer, you don't want to get a trade. What can you do? How about now you sell the 105, the 100 calls, and buy the 105 calls? And so what you've done there is that, the advantage is that you can profit from a change of direction, to offset the loss in the put spread. But there is a disadvantage there, of course, too, is that now the window is really tight for you to make money. But the one other advantage is that when you sell the call spread, what are you doing there? You're taking advantage of the volatility skew by selling the hundreds and buying the 105s. Almost always you're going to be taking in some skew difference or the volatility skew. So that's what I'd like to tell customers. You put on a credit spread, a put spread, goes against it. You don't want to get out. How do I adjust? Maybe you sell the corresponding or a little lower call spread.
I know a lot of you right now are screaming into your podcast player of choice about this next strategy. So I couldn't really close out the basic short premium adjustment part of the show without getting back to this one adjustment, which is probably the mother of them all, particularly for a show like this. A lot of people coming to it from the stock world, and they love to get into covered calls. And they all pretty much listen to this show. They all want to know, what do you do when the underlying rallies to your strike, or God forbid through it? It's probably the number one question we get on the show, number one adjustment question, certainly. So I would be remiss if I close out this portion without touching on that specifically, because I know so many of you want it. We've said it on the show in the past, when the underlying goes to your strike or through it, it's not usually the worst thing, listeners. It can be a good thing. It's sometimes that's what you want to happen in a position like that. But I know that blows a lot of your minds collectively when you hear stuff like that. So luckily we have Uncle Mike Tusa joining us on the show today. He specializes in rolling covered calls. It's kind of what he does all day. So Uncle Mike, walk us through your criteria for when you set up a covered call, when you will roll it versus when you will just let it kind of set and forget it and let the stock be called away, and how you break down that decision on a trade-by-trade basis.
Got it. Well, the first thing that I want to mention is I want to quote my high school wrestling coach. He often told us that the best way to get out of a double chicken wing is to never get into it in the first place. And so with that being said, if you're concerned that the stock's going to get called away from you and you don't want that to happen, and that absolutely can't happen, then don't get into it in the first place. So what I like to do is, my favorite way to adjust a covered call is to just let it get called out and start again the next month and repeat with another stock or with another ETF, whatever the case may be. That's probably the easiest way of doing it, because where you run into difficulty is, let's say that you're trying to roll a covered call up and out, or you're just rolling it up. If that's the case, volatility becomes less and less as the market goes higher, a lot of times. Not always, but a lot of times. And so if you're trying to buy to close the covered call and then maybe sell another one a month further out and then maybe at a higher strike price, that can get difficult after a while. Now, sometimes you can do it and sometimes it can work out, but typically it's not a winning battle. What I like to do with this is, I like to do, if I want to sell premium and I don't want to get called out of the stock, then what I like to do is allocate some additional capital on the side. So let's say XYZ stock's trading at 50 and I want to sell some premium against it. What I would do is take $5,000, put in XYZ stock, and then maybe take another $500 or $600 and then maybe sell a credit put spread or something along those lines. Or the other thing with which you can do, if you want to avoid that horrible, frustrating situation where the stock goes in the money and you think, oh, why did I even mess with this covered call? What you can do, instead of selling a covered call, sell a call spread. So XYZ stock's at 50, you want to sell the 55 call, maybe sell the 57.50 bear call spread. So that way, if the stock does run up, you're still selling premium. You're giving up $2.50 of the upside, but you at least have something with which you can work with. And the rolls would typically work easier when you prepare yourself along those lines before you actually get into it. I'm actually in a trade right now in GLD to where, in lieu of doing a covered call, I sold a 125, and GLD right now, I'm not sure when this show is going to go out, GLD is trading at 124.50, and instead of selling a 125 weekly covered call, I actually did a 125, 128 bear call spread. And so by doing that, if for some reason we have some announcement overnight and gold actually GLD goes to 150, then I'm still going to be a part of all but $3 of it. But if it stays around the same level, I think I paid like 8 cents for that 128 call to hedge it. I actually have some type of a defense mechanism against that.
I can just see all of our listeners right now saying, but if I sell a spread, I don't get my full 28 cents or whatever the heck they're looking to capture, for that covered call. And it's just anathema to them. It's funny. But your advice to them then is for those people, if they don't want to do a spread, to just kind of go the set it and forget it route, let it get called away, and then readjust. They're probably using weeklies if they're doing a lot of premium generating type strategy, so they just readjust for the next week.
That's how I like to do it.
And that is actually a nice thing about the shorter duration contracts. It does speed up that adjustment cycle so that if you are worried about this, you're kind of limited in a 1 week time span of how much the underlying can actually blow through your strike versus a 1 month or a 3 month or a 6 month type option. So your adjustments will come at a more frenetic pace. I suppose that's good or bad depending on your point of view. But if you're worried about this particular type thing happening to you, then nearer term calls are probably the better way to go. Of course, that also maximizes all the things we've talked about on this show in the past, decay and everything else like that you really want to capture when you're collecting and generating income. All right, and you know what? We could keep on rolling, listeners, but we don't have a chance to really scratch the surface of advanced spread adjustments. So I think it's better to really save that for its own entire episode where we can devote a full hour to some of the things Dan was just touching on earlier, adjusting your time spreads and adjusting diagonals and condors and what Dr. I forgot his title, Dr. Toboggan wrote in about adjusting the iron condors when it goes to the short strike and all the myriad adjustments you make on the spread side of the fence. That really is a much more detailed and involved conversation. We kind of wanted to set the stage here with very, very basic adjustments so people know exactly what we're talking about. So in our next episode, when we dive deep into the adjustments, you guys will be prepared. So that is going to do it for this episode of Options Bootcamp. But before we go, let me check in with each of my cohorts, my partners in crime, to see what they have cooking in their respective necks of the woods. John, starting off with you, I know you guys have a lot of cool initiatives cooking over there at sogotrade.com. What's coming up that our listeners could look forward to?
The one great thing we have is right now we have a beta version of our, I know I keep saying this, but our elite platform. And the reason why I like it is that when it was first being developed, if you wanted to get historical volatility on an option, not the 6 month or 3 month, but an actual particular option, it was kind of hard to find it anywhere. I mean, it was very hard to find. So on this platform, we enable customers to go back. If you want to see how the Jan's 15 options have traded over the last year, you can do it. So that's pretty exciting. I mean, we've had customers, believe it or not, request that, and it's hard to find anywhere else. So that's really nice. And we have our advanced screener that's coming out soon too. And even though I'm not a huge big fan of screeners, this one's pretty good because you can customize it. You can put in. You can see. For me, it's great because you can put in if an option or if the underlying is optionable, there's options on it. So I like to use that for bullish or bearish ideas. So we have a lot of cool things coming out in probably next month, and we're all obviously excited about it, and we're hoping to have some webinars in probably the next month or two. Also, we're going to start a big webinar rollout, so that should be fun too.
All right, listeners, if you want to check out more about that, of course, surf on over to sogotrade.com. Kick the tires, light the fires, do some paper trading over there, play around with the tools that John's always talking about here on the show. I think you're going to like it. And when you actually start trading, hey, guess what? You'll actually save some money as well. So there are certainly worse things in the brokerage world. And you can, of course, also click on the education tab there. You'll find John's blog. You can find links to all the episodes of this show. If for some reason you're having trouble finding it on all of the myriad other outlets, or maybe you just prefer to listen to it while you're over there at the Sogo Trade website, you can do that as well. So a lot of great stuff. Surf on over there to sogotrade.com and check it out today. And next up, Mr. P, Mr. Passarelli, how go things in the elite world of market taker mentoring?
Oh, things are going really well, with the market kind of being a little precarious this year. A lot of the smart traders are trying to figure out how to protect themselves in this sort of market and how to make money actually in this sort of market, which as an option trader, there is the potential to do so. So one of the things that we have on the Market Taker website, right there on the homepage, is a little button you can click to get a free report that's called 3 Secrets to Making Money in Any Market. And it's a nice little introductory report that gives you just a couple of generally good ideas, some best practices, if you will. And it's a great starting point, especially if you're new to options. But, I think it could be a nice review for anybody. So, yeah, if you come on over to markettaker.com, 2 T's in a row, markettaker.com, check out that free report, 3 ways to make money in any market.
So let me just save people the time. Those 3 ways: buy straddles, buy straddles, buy straddles. Is that what your report's all about?
No, that is.
Maybe buy straddles, buy straddles, buy strangles. There we go. That's what I was missing.
That's kind of a way where people tend to lose money in every market.
Oh, I had that backwards. I'm sorry. I was thinking of those other reports. All right, and last but certainly not least, Mr. Tusaw, I'm glad you can join us here on the show, and I know a lot of our listeners may not be familiar with what you guys do over there, so why don't you give them a quick overview of what you're working on over there at RCM and things that may interest the listeners here of the Options Bootcamp program.
Most definitely. Well, come to our website. We actually have a couple webinars coming up in the near future. This Thursday night, I will be talking about the ratio spread. Real excited about that. And then a week from Thursday, on February 20th, we actually have a special guest coming to TNT, Thursday Night Trading, we call it. Mr. Dan Passarelli is going to talk about protecting yourself in a down market. So we're excited to have Dan come back and do another webinar with us. And check out our website, www.rcmwealthadvisors.com/webinars for more information on signing up.
Yes, listeners, the options world is just that small. Everyone keeps jumping on everyone else's shows and programs and webinars. All right, and that is going to do it for this episode of Options Bootcamp. Let me encourage you again, if you have whatever mobile device you may like, Android, Amazon, iOS, check out the Options Insider Radio mobile app. I think you're going to like it. And on behalf of John and Dan and special guest Uncle Mike Tusaw, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing and for sending in such great questions like Dr. Toboggan. Keep it up, and we'll see you next time right here on Options Bootcamp.
Options Bootcamp is brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.